Okay, good morning, everybody from Carmel, California. Um, Today I wanted to talk about trading options in a market that's in a correction mode, and that's one of the more difficult phases to be as traders to profit in a market that's in a correction mode as opposed to a bull mode or a bearish mode. So anyway, let's look at the strategies we were looking at and have been working very well in this kind of market. So we're going to have a Q&A session at the end, and we're going to look at our option spread strategy for profiting in this type of market. We'll look at some long and short trade opportunities for this year, and all of the strategies that I discussed today are covered in detail in the Guaranteed Real Optioneering Winners Manual, and we'll be offering that at the end of the webinar. So everything we discussed today is covered in that manual. So the S&P right now is down about 10% from the high, so that it would be in what we would consider a market correction mode, and it's too early to tell at this point if the correction will develop into a bear market, which would be defined by a 20% decline in the S&P 500, or if we'll see a very choppy bottoming process like we did in 2010 and 2011. And I think that's probably going to be the outcome of this current correction. We'll have a very choppy bottoming process, and the bull market will resume just like it did in 2010 and 2011. So what I did is I put a price chart up here. This is the daily price of the S&P, and this is the price action over the last 12 months. And then below here is 2011. So you can see there's some similarities there. So I think we'll wind up probably having a market like we did in 2011. And in 2011, the S&P actually opened the year at 1257 and closed the year at 1257. So you had all this choppy action in here with no clear trend, and the index was literally unchanged that year. So I think we're in for a similar type of market action. Here's 2010. Again, a lot of price volatility, but difficult to trade from either the long or the short side when you have that kind of volatility. So what we do is we'll take long trades in the strongest sectors, and then we'll take bearish trades in the weakest sectors. So right now we have both long trades and bearish trades on at the same time, and what we do in these kind of markets, or actually in any kind of market, is when we have a profit in an option, whether we buy a call option or we buy a put option, if we get a profit in that option, we'll go ahead and create a spread trade, and that spread trade allows us to lock in profits with our existing trade. So that's really the most important thing you can do as option traders, is if you buy a call option and you have a profit, create a spread to protect that profit. And if you buy a put option and you have a profit, then create a spread to protect that profit. So that's the most important thing in this type of market, especially this type of market, but we do it all the time, and it's worked out pretty good over the years and has allowed us to produce consistent profits. So spreads will protect a bullish trade if the underlying stock declines in price, and spreads will protect a bearish trade if the underlying stock rallies. And I'll show you some examples of those. So these spread trades, once we establish them, they can profit if the underlying stock increases, stays flat, or decreases. And it's even possible with these spreads to lock in and guarantee a profit on your trade no matter what happens to the underlying stock. So I'll show you some examples of that. So A little bit of background about Hughes Optioneering. I took a snapshot yesterday, and we had $1.3 million in closed trade profits over the last 12 months. And this is a summary from my E-Trade brokerage account, and this was as of February 19th of 2015 to yesterday. So over a one-year period, we had $806,000 in long-term gains and $544,000 in short-term gains. So I just wanted to show you this to give you an idea of the kind of trades that we have on. And what I'll do is I'll just scroll through these pretty quickly. These are all our actual closed trades over the past year. And we hit most of these are spread trades. So most of the losing trades that you see are one side of a spread trade, and the spread could have been profitable even though one side of it loses money. So most of these losses are just one side of a spread trade. So anyway, we had 1.3 million in closed trade profits trading these spreads that we're going to look at today. We have over 60 years of combined trading experience, and we started teaching our option strategies to other traders over 21 years ago. And I started out with a $4,600 trading account. That's all I could muster at the time. And in my first 2 years of trading, my tax return showed that I had $460,000 in profits, which was actually more than I made the previous 6 years as an airline pilot. So this was my backup plan B in case I got laid off for the airlines or my airline went bankrupt. I developed this trading skill, and that was my backup income. So I'm just showing you my Schedule D tax returns those first 2 years where I made $460,000 trading. So we also enter the World Trading Championship, and that's a real money trading contest, and then the trader with the highest percent return at the end of the year gets first place. So I've been entering these World Trading Championship since the 1990s, and I've won 8 first place trophies and 4 second place and a third place. So I've won 8 times, which is more than any other trader in the history of the competition. And again, these are real money results that are audited before being posted on the sponsor's website. So this is just a snapshot of last year, where I took first place last year, and I had a 309% real-time return trading options. And the year before, I took second place with a 339% real-time return. So I'm not showing these profit results to you to brag, but I just want you to know that these strategies are working in the current market environment, and I just want you to feel comfortable that you're learning from somebody that actually trades. So let's look at our trade selection process. We have a 3-step process to select trades, and step 1 is we determine the price trend of a stock using the 50 and 100-day exponential moving average system. Step 2 is we want to confirm the price trend using the on-balance volume line. And then step 3 is we use what we call the 1% rule to select an option strike price with a high probability of success. And this is a simple rule of thumb that I'll show you that helps you select option strike prices. So if you don't learn anything today, I think this one rule is pretty important for option traders. And our option trading is longer term. We go out usually 1 month to 3 months with our option trade, so we don't follow the market closely. We just look at it once a day, and if we buy a call option and that trade moves against us, then we'll simply exit once we get to about a 20 to 30% loss. So we start looking to exit our trades if we're down 20%, and then we're certainly out by 30%. So we have a simple rule to simply exit our trades and take our loss. And then we also have a rule that if we, as I mentioned previously, if we have a profit in a trade, then we'll go ahead and create a spread trade to lock in that profit. So these are the three rules we use to select trades. And what I'm showing now is this is the daily price movement of the VIX, the volatility index, and this is the fear gauge. So every one of these spikes here that you see is a market sell-off, and every one of these declines that you see is a market rally. So as option traders, we're faced with trying to time our entries in option trades so that, you know, obviously we don't get stopped out. But as you can see, whether you're taking a long or short trade, you're always facing the risk that you're going to lose 100% of your premium whenever you buy an option. So what we try to do is minimize our losses and extend our gains, and that's worked out pretty well for us. So the goal of Prime Trade Select is to not to get stopped out, and then to create a spread trade when we do have a profit, and if we do have a loss, then we get out quickly before it develops into a big loss. So the option trading, as you know, can easily result in 100% loss of your premium, and we don't like to do that. So we don't want to be in a position where we take a big loss on our option. I mean, it only takes a few losses like that and you can get wiped out. So let's look at step one of Prime Trade Select, and that's to determine the price trend. So the goal of a trend following system is to determine the price trend, and if you use a trend following system, then you can quantitatively measure the buying selling pressure of a stock, and that allows us to follow the trend instead of trying to predict the trend. And we like to use a system instead of emotional decision making, and we've been using trend following successfully for more than 30 years. And our trend following system works just as well in down markets, and during the 2002 and 2008 bear markets, we were heavily short, and we had very good years those 2 years when we were in severe bear markets. We were short just about every market during those bear markets, and we did very well. So Prime Trade Select works both ways. We take both bullish and bearish trades, and it's a very simple system. With Prime Trade Select, if the 50-day exponential moving average is above the 100-day EMA, then that stock is on a buy signal, and if the 50-day exponential moving average is below the 100-day, then that stock is on a sell signal. So we purchase stocks or call options when a stock is on a buy signal, and then if a stock is on a sell signal, we purchase inverse ETFs or put options to take a short position. And as I mentioned, the system works in both bullish and bearish markets, and we've done very well in bear markets. So let's look at an example of a stock that's in a buy signal. This is a price chart for Cigna, the insurance company, and the red and black vertical lines here are the daily price movement, and this blue line right here is the 50-day exponential moving average. The red line is the 100-day exponential moving average. So we can see back in September, the blue line crossed above the red line. So once that occurred, then this stock was on a buy signal, and as long as the 50-day is above the 100-day, then the stock will remain on a buy signal. Here's an example of a sell signal. This is for the FXI, that's the China ETF, and we can see right here the blue line, the 50-day exponential moving average, crossed below the 100-day. That was back last July, and as soon as the 50-day crossed below the 100-day, then FXI was on a sell signal, and as long as the 50-day is below the 100-day, then the ETF remains on a sell signal. So we use a very simple trend indicator to determine whether a stock is on a buy or a sell signal. And then step two is we like to confirm the price trend, and we use the on-balance volume line to do that. And I'll just show you a couple examples of option trades that we took recently. And this is the daily price chart for Amazon, and the red and black lines right here, the daily price movement of Amazon, and the 50-day EMA is this blue line, and we can see once it crossed above the 100-day, then Amazon was on a buy signal, and then that signal was confirmed by the on-balance volume line, and we can see that the on-balance volume line is sloping up in this case. And what that indicates is if it's sloping up, it means that on days that the stock closes up, the up volume was heavier, and on the days that a stock closes down, the down volume is heavier. So it's a measure of volume flow which precedes price, and we like to confirm the price trend by just checking this on-balance volume line very quickly. And both the 50 and 100-day EMA and on-balance volume can be downloaded from any number of websites. We like stockcharts.com to get our indicators. It's very simple and quick and easy to take a look at our indicators. So Amazon was on a buy signal. According to our trend, it was confirmed by an upsloping on-balance volume line. So right in here, we bought the Amazon 330 strike call option right in here based on that buy signal. Here's another example. This is for Netflix. Again, it was on a buy signal, and we had an upsloping on-balance volume line, so we bought some Netflix call options. Here's another example. This is Starbucks, and it was on a buy signal, and it was confirmed by the upsloping on-balance volume line, so we bought the 40 strike call for Starbucks. And then step three of Prime Trade Select is we want to use the 1% rule to select an option strike price with a high probability of success. And when you decide to trade an option, there could be hundreds or even thousands of strike prices to choose from. So selecting the strike price is just as important as the trade selection itself. So as you know, option premiums consist of time value and intrinsic value, and options lose all time value at option expiration. So when you buy an option, you're buying a decaying asset, and each day that option is going to lose time value until it gets to expiration, and then there will be no time value left. So you always have to keep that in mind whenever you buy an option, that you're buying a decaying asset. So due to the time decay characteristics of options, when we buy an option, we want to minimize the time value, and we want to maximize the intrinsic value, because the time value is going to go to zero. So the way we do that is we limit the, when we buy an option, we limit the time value portion of that option to less than 1% of the stock price. And if we do that, the stock only has to go up 1%, and we're going to break even and start making money. So it's a very simple rule of thumb, but it's very important when you're trading options that you select a strike price that you're going to have a good chance of making money. So if you limit the time value portion of an option to 1% of the strike price. Again, the stock only has to go up 1% in order for the trade to break even and for you to start making money. So this obviously is going to have a much higher probability of being profitable than an option strike that requires, let's say, a 6 to 10% increase in the price of the underlying stock to break even, because a lot of times you're not going to get that 6 to 10% increase if in a 1 month period or 2 month period, whatever your however far out you go with your option, usually 1 to 2 months, you may not get that movement, and if you don't get that movement, then you risk 100% of your premium. So we don't want to be in that position, and we want to be able to buy an in-the-money option, and then if we get behind on it and we lose 20%, then we'll start looking to get out of the option. That way we preserve our capital and we can just move on to the next trade. So if you use this rule, you're going to have a much higher probability of being successful than selecting an at-the-money or an out-of-the-money strike that requires a big move in the underlying stock, because a lot of times you're just not going to get that move. So let's look at an example. This was the Starbucks 40 strike call option that I showed you. We bought that at $13.75, and at the time Starbucks was trading at $53.63. So let's look at the time value and intrinsic value portion. So the Starbucks stock was trading at $53.63. We bought the 40 strike call, so if we subtract that strike price from the stock price, we can see that that option had an intrinsic value of $13.63. So we paid $13.75 for the option, and if you subtract the intrinsic value from the total option premium, we come up with a time value portion for this particular option that we bought of 12 cents. So the total premium was $13.75, intrinsic value $13.63, time value is only 12 cents. So let's look at our call option purchase calculator, and we have 6 different calculators that we developed over the years that will give us the profit loss potential for our various option strategies. And what we're looking at now is a call option purchase calculator, and this will calculate the profit potential of buying the Starbucks 40 strike call at $13.75 when Starbucks stock was trading at $53.63, and it'll calculate the profit potential based on the price of Starbucks stock at option expiration. And in this example, we're assuming in this first column here a 30% increase in the stock to a 5% decrease in the stock. So the bottom row here will give us the percent gain or loss for the option, and the second from the bottom will give us the dollar profit or loss based on the percent move in the underlying stock. So with this particular option, if Starbucks stock was flat at option expiration at $53.63, you can see we're going to lose just under 1%. We'll lose 0.9%. If the stock is up 10% at $58.99, we'll have a 38% return. And when I took this snapshot, it was trading. The stock was trading at 59, so we had about a 38% return for this option. So even though we bought a deep in the money option, you can see we still get a good return. If the stock is up 10%, we get a 38% return. If the stock's up 20%, we have a 77% return. But more importantly, if the stock is flat, we only lose 0.9%. So if you buy an at-the-money or out-of-the-money call and the stock is flat, you're probably going to have 100% loss. So we like to limit our risk on the downside by using this rule. So even though we're giving up some of the profit potential, we don't like to be in a position where we're going to have a 70 or 80 or 100% loss. We'd much rather manage our loss by being able to simply exit the trade when we have a 20% loss. So that way we preserve our capital and we can just move on to the next trade. And the call option purchase calculator also calculates the time value. We can see the time value is 12 cents, intrinsic value is 13.63. So even though we're buying deep in the money calls, we still get a good return with a small price movement. In this case, a call option. So even a small up price movement in the stock, we get a decent return. So again, in this particular trade, there's only 12 cents of time value, so the stock only has to go up 12 cents, and we start making money. Okay, so Prime Trade Select has produced a lot of winning trades, and we have a trade management rule that if we have a 30% profit in our option, then we'll go ahead and create a spread trade. And the spread trade provides downside protection. It helps protect the profits, and it also allows us to hold on to winning trades during market sell-off. So a lot of times if you have a winning trade, it can quickly turn into a losing trade with market volatility. So when we create these spreads, it allows us to hold on to these winning trades through market volatility. So spreads, of course, have a long position and they have a short position. The long position profits as the underlying stock moves up in price, and the short position profits as the underlying stock moves down in price. So it's possible for these spreads to profit if the underlying stock increases, remains flat, or declines in price. And with the spreads, it's also possible to lock in and guarantee a profit for the option trade, and I'll show you some examples of that. So we call these market neutral spreads because they have a long and a short position. And if we buy a call option and we have a profit on the call option, then we'll go ahead and buy a put option to create a market neutral spread. And this can be done simultaneously, or you can leg into the put option at a later date if you have a profit in the call option. And that's the way we usually like to do it. We'd like to buy a call option, and when we get a profit, then we'll buy a put option. So, of course, the call option that we bought will profit if the price of the stock moves up, and then the put option that we buy will profit if the price of the stock moves down. Your risk is limited to the cost of the spread, and there's no limit on the profit potential if the underlying stock continues to increase in price. So once you buy that put option, if the underlying stock continues to move up in price, then your profit for the spread will continue to go up. So there's no limit on the profit potential. So what we did was we bought call options on Amazon, Google, Facebook, Netflix, Starbucks, and the XLV, which is the healthcare ETF. And what we did is we had profits in these, so we went ahead and bought put options. We went out to January and March of 2016 with these put options. So we had a profit in the call option, and we bought these put options to protect those profits. And we'll take a look at an example of some of these spread trades. This first one was for Home Depot, and we bought a call option for Home Depot. We used our trade selection rules and the 1% rule to select the strike price, and this is just a snapshot of the open trade profit for Home Depot, and we bought the 80 strike call at 10.15. So we had 45 contracts. We had a $120,000 open trade profit, and what we did is we bought a put option, and we usually go out several months with the put options, and then when they expire, then we'll just roll it over and buy another at-the-money put option. So we had a profit in the call. We bought a an at-the-money put option to protect those profits. And we bought, in this example, we bought the 110 strike put at 420. So again, just to summarize, we bought 45 of the 80 strike calls at 10.15. We had a profit, and we closed out the put options, the expiring put options, and then we bought the 110 strike put option at 420. So bought the call at 10.15, bought the put at 420, and we have a calculator that will calculate the profit potential for market neutral trades, which is one of our 6 strategies, and this will give you the profit loss potential for this spread trade using various assumptions of where Home Depot stock will be at option expiration, in this example from a 30% increase in the underlying stock to 100% decrease. Now, I don't expect a 100% decrease in Home Depot, but I just put that in here just so we can look at the risk profile. So for the spread now, again, we bought the 80 strike call 10.15, bought the 110 strike put at 420. So we can see at option expiration, if Home Depot stock was flat at 115, then the spread would realize a $2,082 profit and 145% return. So the minimum return for this spread trade would be 145%. And then the profit potential is not limited, so we can see if Home Depot stock was up 10%, we'd have a 225% return and a $3,200 profit. So as the stock moves up in price, you can see that the profit potential is not limited. So the profit potential continues to go up. And also, this is interesting, if the stock goes down, then the profit potential increases also because of the put option we bought. Now, with this recent market sell-off, we do have spreads that are down. This underlying stock is down considerably. It could be down 10, 20, 30%, but we're actually making money with the spread trade because of the put option we purchased. And you can see that the profit potential keeps increasing the more the stock goes down in price. So we're in that mode now with some of our positions where the stock is down a lot, but we still have a good return. So in this example, our minimum return you can see is 145% and a $2,082 profit. So once we buy the put option, then we just forget about the trade. We don't have to watch the markets. We don't care about earnings reports. We don't care about market sell-offs. We simply buy the put option and we can forget about the trade until option expiration, and then at that point we either buy another at-the-money put option or we cash out if the stock is really gone down and it's on a sell signal. So we won't roll over if the stock is on a sell signal. So this just gives you an idea of the profit potential for these spread trades, and we don't have to worry about protective stops or bad earnings reports or big down moves. So this is a very low stress way to trade options. And here's another example. This is for the XLV, the healthcare ETF, and we bought the 50 strike call at 960. We had 64 contracts. We had a profit, so we went ahead and bought the 75 strike put at 4 points, and we'll take a look at the risk profile for this trade. So again, we bought 64 of the 50 strike calls at 960 and bought 64 of the 75 strike puts at 4 points. So with this trade, we can see that if XLV is flat at option expiration, and we would realize a minimum return of 83% and $1,140 profit. And if XLV goes up, then our profit potential keeps increasing at option expiration if the stock goes up, and if the stock goes down, of course, our profit potential keeps increasing. So it's a very low stress way to trade options, and this XLV actually did decline, and the put option kicked in, and we had a nice profit for this trade, even though the XLV declined about 20%. So it's a great way to trade options. So I'm going to look now at this is a portfolio of market neutral trades in our brokerage account, and what I did is I put each one of these trades, I used the market neutral calculator to calculate the profit potential for, and this at the time we had trades on for Cigna, Costco, J&J, Starbucks, Wells Fargo, and Yahoo. So what I did is I ran each one of these market neutral spreads through the calculator, and then I calculated the profit potential for this portfolio as a whole, just to give you an idea of the profit potential for these particular trades. And this open trade report on our brokerage account, in this column it lists the dollar profit or loss for each option trade, and then this column lists the percent profit or loss. So for the first example with Cigna, we had at the time we had a $1,400 open trade profit in the call. We had a loss on the put, a loss of $158. So these are all market neutral spreads, and just to give you an idea of the return for this portfolio, and I summarize it in this table below here. So if the stocks in that portfolio at option expiration close flat, at option expiration we'd have a 277% return, and if the stocks on average in the portfolio went up 10%, we'd have a 700% return. So you can see for the portfolio as a whole, we get a really good return even if the stocks are only up 10%. And then of course if the stocks go down, and we also profit if the average stock in the portfolio goes down 20%, we'll have a 1,200% return. So you can see you're pretty well protected, and the minimum return for this portfolio it would be 277%. So this is a great way to trade options. If the stocks go up, we make money. If the stocks go down, we make money. And if they're flat, we make money. So this is the way we like to trade options. Okay, and this is just a snapshot. We took open trade profits for one of our market neutral spreads, and in this particular account, we had a $70,000 open trade profit. We had a spread for Apple, Facebook, Google, and the QQQs. Here's another example in this portfolio, and this was actually a retirement account. We had $199,000 open trade profit in the portfolio when we took the snapshot. So that gives you an idea of the type of spread trades we like to create to protect our profits, and in a lot of cases we can guarantee a profit by buying that put option if we have a profit in the call option. So this is the way we like to trade options. And let's look at some short trades that we currently have. And with short trades, we found over the years that we use the 50 and 100-day exponential moving average trend following system to select a short trade, but we found over the years that we also want to check the long-term trend of the stock, and we only take short trades if the long-term trend is also down. So we don't want to take a short trade in a stock where the long-term trend following system tells us it's still on a buy signal, and that helps cut down on losing trades when you're taking short trades, and it helps prevent being whipsawed. So in other words, we check both the intermediate term trend of a stock with the 50 and 100-day exponential moving average, but you also want to check the long-term trend of the stock too, and we'll only take short trades if the long-term trend is down also, and that results in a higher percentage of winning trades. So what we do is we look at the 50-day EMA in relation to the 100-day EMA, but we also look at the 1-month price in relation to the 20-month EMA, and we consider that the long-term trend, the 1-month price, and then we'll look at that in relation to the 20-month EMA. So if the 1-month price is below the 20-month EMA, then that stock is on a long-term sell signal, and then it's okay to take short trades. So we found the short trades are more accurate if you take the trade in the direction of the major trend, and we have fewer of those whipsaw trades when you have a counter trend rally. So here's some of the short positions we have on right now for Fortinet. That's a internet software, the China ETF, financial ETF, biotech ETF, and the small cap ETF. So these are inverse ETFs that we bought. This first one is for Alibaba, or no, these are put options that we bought. These are March put options that expire next month. So Alibaba, symbol BABA, it was on the 50-day exponential moving average, was below the 100-day exponential moving average, and the 1-month price was below the 20-month EMA. So we had a confirmed sell signal for Alibaba, so we bought a put option. This is Fortinet, bought a put option in Fortinet, and this is the biotech ETF, symbol XBI, and we bought a put option on that. So these are examples of put options we bought on stocks on a sell signal, and this portfolio report here these are inverse ETFs that we bought also. So all these ETFs and stocks were on a sell signal, so we bought a combination of put options and also bearish ETFs. This is the Russell 2000 bearish ETF, financial bearish ETF, China, and biotech. So let's look at an example of these trades. This is for the biotech ETF, symbol XBI, and we can see back in September, 50-day exponential moving average dropped below the 100-day, so this was on a sell signal, and we can see that the on-balance volume line was also sloping down. So what that means was on down days, the selling pressure was heavier, and on up days, the buying pressure was lighter. So this confirmed this price trend. When you get this down-sloping on-balance volume line, you can see that the volume flow is heavily to the downside.
Hi,
and
Chuck.
Here's the yes.
Sorry to cut in here. We have reached our time. If you could just start wrapping up and showing everyone, the final slides and everything.
Okay.
I would be very appreciative. Thank you very much.
Okay.
Just like giving you a heads up.
Okay, sounds good. And this is the long-term trend, the 1-month and 20-month for XBI, and we can see that the 1-month price here dropped below the 20-month EMA, so it was also on a long-term sell signal. Here's the Russell 2000 on a sell signal confirmed by the down-sloping on-balance volume line, and also the long-term trend is down. So these are just examples of sell signals that we have on right now as a result of the short and long-term trend following systems. So what we started doing was when we buy a put option, we have a profit, then we'll go ahead and buy an at-the-money call option to create that market neutral spread. and that'll help lock in the profits of the put option by purchasing that call option. This is just a snapshot. We have an advisory service where we make trade recommendations, and this is one of the portfolios in that advisory service. This is the market neutral portfolio. So these are the trades that we have on, and the open trade profit is $200,000, and we have average return of 90%. But the interesting thing is, even if these stocks all go to zero, we're still going to have a profit in this portfolio. So this portfolio is fully protected, guaranteed to make money no matter where the stock market goes. So if you're interested in our advisory service, then you can just log on to weeklyoptionalert.com, and if you click the trade results tab here, you'll see our open trade profits for our various option strategies. So if you just want to get an update on the profit results, you can just log on to our website and click trade results. So today we're offering a package, and if you go to tradewins.com/grow, G-R-O-W, what we're doing is we're offering this manual, the Guaranteed Real Optioneering Winners Manual, along with the Optioneering Weekly Workshop newsletter that comes out once a week, and it has trading ideas for the current market conditions. So we're offering this for $39 a month. You can cancel at any time, and again, you get the manual, and you also get the weekly newsletter that makes trade recommendations for our various option strategies. So we're offering that for $39 a month, and you can cancel at any time, and just log on to tradewins.com/grow to order this package. So again, this manual covers everything that we went over today, and it's a pretty handy manual if you want to get into spread trading, and it shows you how we leg into these spreads and select these spread trades. So anyway, that concludes my presentation.